The goals of international financial management. In the Principles of Finance class, we have learned that the goal of a corporation is to maximize the shareholders' wealth. If it is for a publicly listed company, then the shareholders' wealth is represented by the stock return in the long run. So that's the goal for a corporation's existence. However, complications may raise if we're in an international background. The goal of corporation I just mentioned existed in the Anglo-Saxon countries, namely United States, United Kingdom, South Africa, Australia, New Zealand, and so on. But for other companies in other countries, then it could be a little bit difficult to identify who are and where are the shareholders. For example, like Disney, a lot of the shares are owned by investors from Saudi Arabia. And in what currency should the company maximize their shareholders' wealth? And also, this goal is challenged by other corporate culture, like in the European countries, shareholders is just one part of the stakeholders of the company. The other stakeholders include employees, suppliers, customers, and so on. In Japan, the managers have typically sought to maximize the value of the keiretsu. This is a Japanese word for conglomerate or a group of companies. And this is a family of firms to which the individual firms belongs to. And a good example would be Mitsubishi. You know, you drive Mitsubishi's cars, and also they have a Mitsubishi construction company produces bulldozers, and also Mitsubishi Bank. You know, sometimes the one of the Mitsubishi company is in trouble. They may need loans, but for a regular banking practice, they do not deserve a loan because the risk is so high. They have too much default risk. But for a Mitsubishi Bank, it's an obligation to help the entire family of the Mitsubishi Group. They may issue the loan to that troubled Mitsubishi brother. And in China, everything is quite different. Everyone must listen to the government, and you must pay your taxes. If there are some macroeconomic policies imposed by the government, you have to fulfill that, although at the sacrifice of the company's shareholders. And if we get a closer look at the definition of multinational corporations, they have businesses in a lot of places, and a lot of them are overseas, and they also have financial channels in another country, and their headquarters, their productions may be located in other countries as well. So there are about 60,000 multinational corporations around the world. They just do businesses covering a lot of regions in the world. So let me just zoom myself up. And then the multinational corporations, they deal with their international subsidiaries, international product markets, and also international financial markets. They need to transfer money in and out, and they have to deal with the exchange markets, so to convert US dollars to other currencies. If you look at the biggest banks in the world, you will see that Citigroup has businesses in over 100 countries. HSBC, which is a British bank, has businesses in 80 countries. And you also know JP Morgan Chase, Bank of America. They also have a great coverage of businesses around the globe. It is worth mentioning that Wells Fargo is not right here because Wells Fargo doesn't have a lot of countries to cover their businesses, but Wells Fargo, in terms of market capitalization, once exceeded all of these banks. These are the top 10 multinational corporations ranking by foreign assets. You can see some of them are coming from United States, and some of them are from Europe, and one is from Japan. Right now, General Electric is not in a very good shape. They have this accounting scandal hovered, and and also their profitability is not doing great recently, so they are facing great challenges. If you look at the largest corporation by market capitalization, so you will see on the top list there are a lot of Chinese companies, namely the Industry and Communication Bank of China, Construction Bank of China, and then you will also see American companies. So this would include GE, ExxonMobil, and Wells Fargo, and so on. Many of these companies are in the financial industry, and also many of these companies are in the energy industry, producing oil and petroleum. Only one company, GE, is in the manufacturing industry. And this list will be updated since GE is sliding down. Okay, so the types of international businesses. So there are 6 types of international businesses the multinational corporations are engaged in. They are international trade, licensing, franchising, joint ventures, acquisition of existing corporation, acquisitions of existing operations, and FDI. We call it foreign direct investment, or establishing new foreign subsidiaries. Okay, so for international trade, so basically we want to buy the raw materials from a place with a low cost, and then we want to earn higher revenue by selling to places with higher prices. And the internet nowadays facilitates the international trade. And licensing basically is about giving another firm your technology, which include copyrights, patents, trademarks, and your name in exchange of fees or other specified benefits. Like Starbucks, they use licensing. They, like the other company, use their ingredient to make money, and they would get a fee in exchange. And this allows the other firms to use their technology. So as for your own, you don't have to make a major investment. There's not much cost for you compared to exporting, but a major disadvantage here is it's quite difficult to ensure the quality, to make sure the foreign partner is strictly enforcing your ingredient and make sure everything is 100% to your recipe. Franchising is another type of international business, and compared to licensing, it involves more investment. So that obligates a firm to provide a strategy, even provide initial support, and this allows penetration into foreign markets still without a major investment. There's some investment in here, but it's just not allowed compared to acquisitions or direct investment. The good examples would be Kentucky Chicken, McDonald's, Pizza Hut. They are everywhere. And if you see a Kentucky Chicken in Indonesia, then you should know that there is a local owner who get a license from the U.S. headquarters in Kentucky, of course, and they receive support from them. They have the operation book and make sure everything is in place according to the headquarters. The headquarters also provides the commercials and all the strategy operating in the country. Joint venture would require much more commitment financially. So you are partnering up with a local company. For example, the General Motors, they couple with the local automobile companies in China and also in Eastern Europe to jointly produce cars and then occupy the markets over there. Acquisition is about getting the full control. So compared to joint venture, acquisition would get the full control of the business. And it is quite costly because you are buying an existing farm, and that farm is already vivid and running and perhaps making profit. So you are paying a high fee for that. And there's also a risk of large losses because you're really making a large investment. The foreign direct investment allows the firm to penetrate the market by establishing new operations. I mean, start from scratch in that country, and definitely that requires large investment. And it's cheaper compared to acquiring an existing firm. And also in the FDI, foreign direct investment, all the needs are tailored to exactly what your company needs in the United States. A good example would be Coca-Cola. They just build factories in India, in China, and use a local worker, use local resources to build the factory and then sell their product over there. Since the trade war between U.S. and China has been pretty intense in the past 2 years, so here I just provide a overview of the trade nature between United States and China. So you will see China is one of the largest U.S. trade partners, and the total trade is on the top list. That is exports plus imports. So U.S. imports to China is like $10 billion, and the imports is $41 billion. And you can see that's a large trade deficit, because when you are importing, you are paying the foreigners money, and when you are exporting, you are receiving money from the foreigners. So the trade with China implies a deficit for the United States. So that means U.S. is paying too much to the Chinese compared to what they make money from the Chinese. For the other trade partners, it's quite balanced, like in Canada, and with Mexico. But with Japan and Germany, U.S. is also having a large trade deficit, but not as large as with China. So U.S. exports to China, the major products here are oilseed, aircraft made by Boeing. Oilseed is agricultural product, first of all, and also vehicles like cars, like bulldozers, and also machines, engines, pumps, electronic equipment. And what we buy from the Chinese, those are electronic equipment, machines and engines and pumps. You see, these item is on the list of both import and export, but we're talking about different level of machines and engines. When U.S. buy from China, those are stuff with a lower level technology, but when U.S. is selling to China, these machines and engines are more cutting edge, advanced in technology. So the licensing and the franchising business in China here, so you can see licensing and franchising here include McDonald's, Kentucky Chicken, Pizza Hut, and when you're doing a franchising, you need to, the American headquarters needs to provide the marketing strategy and establish a system and make sure the process is running, provides training and support, and so on. And the local franchisee will provide the capital, labor, and their commitment to follow the system and also taking the risk. And here is a picture of a joint venture in automobile industry in China. As you can see, not only the U.S. Company like GM, like Chevrolet, is partnering with Chinese manufacturers, but also companies like BMW from Germany, or Toyota from Japan. They are doing the same thing, competing in that market. And for acquisitions, you will see the Starbucks have been doing a lot of joint ventures, and they also have acquired local companies, like some catering company in Hong Kong, or some coffee shop in Beijing to make sure their strategy is fully implemented. And if they obtain the full ownership of these companies, they would achieve higher operating efficiency and also reach higher accelerated growth. Chinese acquisition of U.S. companies, that means when the Chinese are buying U.S. companies, here is also showing the map. So they range from aircraft industries also to the food industry and the property industry. The largest deal ever made was by a company called Shuanghui. They purchased the Smithfield Food Company with a fee of $7.09 billion. And for foreign direct investment from China, it also increasing because the Chinese are pulling more and more money, investing in the United States and also in the European Union zone. But the investment in the U.S. is larger. And for the U.S. companies investing in China is also growing. Who are the big players? You can see Apple, Nike, Gap, Coca-Cola, Ford, and so on. The Chinese currency is called the Chinese Yuan, and they used to adopt a pegged exchange regime. So that means the exchange rate was fixed for quite a long time, and then due to the pressure from the U.S. government, the exchange rates were allowed to change, and then the Chinese yuan appreciated to a certain level, and then it keeps it flat for a while.